Hello, everyone. This is Tony Christ in Falls Church, Virginia. Ismail is with me in Austin, Texas. I want to welcome everyone to this week's program, and we've called it, and we will continue to call it, Sunshine and Transparency, with a focus on transparency. I have a few comments to make. I'm going to turn it over to Ismail. For weeks now, we want to take a look. We've talked about many social issues. Today, we're going to start on the economy. This is the first week we're going to spend on the economy. It might be a few minutes longer, but we hope you feel it's worth your while. We talked about the Federal Reserve earlier. We want to emphasize that Federal Reserve cannot create wealth, and there's a danger, too, with the Federal Reserve. When they work with Congress and the Treasury, they can actually destroy the value of your currency. But we'll talk about that later too. But I want you to be in mind and of that mind, because too many people in the market breathe or die on what the Federal Reserve says every day. And remember, they can't create wealth. They just print fiat money and they create debt indirectly through doing it. And you need to know that. Now there are investors today and investment theorists at all the major firms. Goldman Sachs came on yesterday, the head of research, and he said he sees no threat of a recession because the nominal wages will be increased next year by over 3%. And even though we are spending all the money we accumulated in 20 and 21 and will be out of it soon, expected to be out of it in first quarter, that additional 3% will keep up the spending level, and so you won't have the consumer pull back. That's what Goldman Sachs says. Investors, for some reason, have become remarkably confident that inflation will keep trending down. Should they be? We'll talk a little bit about that today. There's a 50% probability that people feel the Federal Reserve will start lowering rates by March. And there's an overwhelming probability that they'll start lowering the Fed funds rate, which is the overnight rate, which will affect other rates too, by May. Is this correct? We'll talk a little bit about that. And most importantly, listen to this. There is 100% likelihood. All of the pundits and theorists in the market, there's not a one of them, not a one. Now, of course, there will be one out there somewhere, but the vast majority, let's call it 99%, believe that it will be impossible next December for the 10-year bond to be at 5% or above. Now, that concerns me because I don't think that everything's probability in our business and in life. But I'd be very careful about that one. That one will come into our discussion on the economy today. So a few points to start out. We mentioned before labor productivity and how strong it is. If you want to look at Mr. Biden's term in total, he had the worst record of labor productivity all the way back to Obama going into 2 quarters ago. Then 2 quarters ago, it shot up to 3.5%. And last quarter, it went to 4.7% non-farm labor productivity, which is way above what he averaged, which was between 0 and 1%. The long-term average is about 1.5%. Labor productivity is output over cost in a simple world. So when the number's higher, you're getting more output for a set cost. So the last 2 quarters have come in very surprisingly strong with labor productivity. We're going to talk about M2 also. Yesterday, the employment figure was announced, up 190,000, and unemployed dropped from 3.9 to 3.7%. Dropped to 3.7%.
3.7, yep.
And U6 unemployment remains pretty high, though. U6
I think it's right around 7 points.
Yeah, but because of the number of people in the labor force, there's more people out of the labor force. And out of 99 million, I think it's estimated to be 5 to 6 million people that are looking for jobs and aren't counted. Now, that's another thing that none of the political pundits talk about when they talk about the unemployment rate. But the unemployment rate, right or wrong, it's the same number. They can do it the same way, at least we think they do each time. So you can compare it. And yesterday was surprising. And I'm going to, Ishmael, why don't you give a couple of other things that have come out, then I'm going to make a prediction.
Yep. And I think the biggest thing that people have been wondering over the last year, you've heard this term we've heard before in our life, soft landing. Are we going to be able to lower inflation without a recession, without job loss, without needing to cause some pain? A year ago, it was predicted unemployment would be higher than it is today, for example.
One point. A year ago, the same people were talking about a recession.
Yep.
And they're
Absolutely.
predicting a soft landing or a very mild recession. To a man, to a man and woman, up and down, all the analysts are in the same boat. I just
100%.
Facts. Go ahead.
Yep, no, absolutely. So a couple things this week that were interesting to me. I think one mentioned the employment rate. We see prime age employment, 25 to 54, starting to get to highs not seen since the early 2000s. Good news. That means people in prime of their life, 25 to 54, are working. Number two, which is something
nudged past the 2019 height.
Yep.
They're not
the 2001 high now. We're approaching that. Number two, what's interesting to me is the Atlanta Fed, their prediction for GDP of Q4, and Q4 is 1.2%. Now that's a slowdown from what GDP came in Q3, but tends to indicate that we're seeing the cooling of the economy without going into recession at this point. And then we have the Michigan consumer sentiment, which came in higher after 4 months of decline. People feeling better about the economy. There had been the vibe session, so maybe people are starting to feel a little more confident. And then finally, as Mr. Chris just mentioned before the call, we see the fear and greed index, which CNN has, which is on the stock market in October. It was in the fear range. Now we're back to greed. So this is just an interesting point to keep about the psychology of the market and how the market is responding to economic news. And as we can see here again, 1 month ago, we were in the fear range.
Well, one thing, and I caution you, when we get to the extreme greed, put your seatbelt on. But that's a short-term up and down index.
Yep.
The inverse, the markets tend to do the inverse of what the index says at extremes. And in between, it's pot luck. So we're not quite in extreme greed yet. Go ahead, Ishmael. Anything else you want to mention?
Those are the big ones that I wanted to hit to start with. Again, we've had, in my opinion, some good news of late. We've seen the market go up. We're starting to reach all-time highs. We're getting close to them in the S&P and in the Dow. We've seen inflation come down, so things look good. But let's see what's under the surface.
Things look good. The majority out there certainly feels that way. The Dow Jones Industrial Average has touched the height it reached on 11/21/21 of 2021. The S&P 500 is 3.6% below the height it reached on December 4, 2021. And NASDAQ is about 9% below the height it reached on November 15th. It preceded the other two highs, November 15th of 2021. So it's a very interesting configuration. The market is almost right at those peaks reached. One index clearly is, the other two are a little bit behind, and who knows, in another week they could be a little bit ahead. But there is a distinct difference. The narrowness of the market and the volumes have declined. By narrowness, I mean there are fewer stocks. You've heard about the Magnificent Seven. Well, they're 38% of the S&P 500, and they have certainly driven the index up. Many stocks have not participated.
Can you give examples of the Magnificent Seven for folks who may not be familiar?
Yeah, Bob, of I guess Google, Apple, Amazon,
NVIDIA.
Tesla. I think Tesla's in it, Nvidia's in it, and that group of gigantic stocks. Facebook, what's Facebook's called now? Meta. They're called the Magnificent Seven, and they're up phenomenally. But they brought the whole index up because there's such a big weight of the index. All right, now, so here we are. We're approaching Christmas. We're approaching year end. Now I'm going to tell you what's going to happen. You ready for this? By the first week in January, I think these signs are going to start to be apparent. Now, we can still go up higher the next 3 weeks, okay? But by the first week in January, I think right around that time, maybe not that day, the markets will peak. And guess what peak means? It means there's only one way from there. Now, I'm going to talk about 11 points that I follow and that I've read a number of people to get these points, a number of very bright people, a lot brighter than me, to get these points. And I want to bring them all to your attention. First of all, I want to talk about the inversion in the yield curve. We're going on 2 years. And generally, when you have an inversion, now by inversion, I mean where in a normal yield curve, a 2-year loan is cheaper than a 10-year loan. Because as you go out in duration, you add expense because you take on more risk. So in a normal world, now in an inverted world, the 2-year interest rate goes above the 10-year interest rate. That's called an inversion. Well, we've had an inversion now for approaching 2 years, okay, of the 2 and 10. And equally interesting, we've had an inversion between the Fed funds rate, that's the overnight rate, the rate the Federal Reserve has increased just unbelievably up to over 5%. Between that and the 2-year, we've also had an equal inversion, and it's not as telling as the longer one, but the fact that they're both there are very telling. And now they have very high probability of predicting recession. Now, we told you many people jumped on their sword last year and predicted recession. And here we are a year later. Now, the reason this is different, in my opinion, the reason I feel this is different, and it's similar too in many ways, but the reason it's different is we never in American history had the federal government build up personal savings as they did by 2021, Biden's first year, although it was done by Trump. I don't want to credit Biden for that one, to 2.1 trillion. I've never in my life seen a savings that high, and it was due to the government sending out checks and actually spending near $4 trillion. So individual household savings went up to 2.1 trillion. Guess what they are now? Well, I'm going to tell you, they're going to run out in first quarter. So all the economic fuel that's been driving the household and the spending they've done is going to have a day of reckoning. It's going to run out. Now, Mr. Goldman Sachs says, don't worry, it's going to be mild, because when they run out, because their salaries are higher, they're going to keep spending. Okay, why is consumer spending that important? Well, because that is what has propelled the economy. That is almost 80% of the economy. And if that dries up, we're going in a recession. Okay, and recession is defined as 2 consecutive quarters of negative growth. Now, I'm sitting here and you say, this guy is nuts. I mean, just weeks ago, we announced the third quarter was 4.7% growth, nominal growth. And how can he be sitting here telling us, without even the fourth quarter data, that we're going into a recession in the first and second quarter of next year? Well, I'm going to finish the story. And you know, between you and me, I sort of hope I am nuts, because I don't want to see a recession. I don't want to see it happen. but I got to call things the way I see them. We're all about the truth. That's what the program's called. That's the name of the program, Sunshine and Transparency. So we got to call them the way we see them. So right now, we have had 14 months of negative manufacturing index numbers. 14 months. I don't remember a time that it's been that long without a recession. Generally, when the numbers decline below 50%, that's in recessionary territory. December 1 reading was 41.7%. That's way below 50. Okay. Now, there's a caveat I should mention. Chicago PMI came out and unexpectedly was expected to be 44%. That's also a manufacturing index. And it came out the day before on November 30th. It jumped up to 55%. Everybody, wow, oh my gosh, we're not going to have a recession. Well, now Chicago PMI is a much narrower group of manufacturing than the ISM index. And I sort of think that was a one-off month. I don't think that's going to be a trend. So I'm going to go with ISM. Now, the other thing, we've talked about excess savings going down from 2.1 trillion to 300 and some billion, headed to zero in the first quarter. Okay, we've talked about the manufacturing index being in a technical recession, a numerical recession, for 14 months. The leading indicators, which predict the future, that's why they're called leading, have been going negative for 19 months. Now, you say, but the gross domestic product, which is the sum total of goods and services, is just going great. The labor market is just real strong. How can this indicate a recession? Well, the thing is today, and you've got to be very cautious because there are differences. We've never had the kind of spending Mr. Trump did before he left, and then we've never had the government involvement in fiscal spending that Mr. Biden has done in his first 3.5 years. And you're talking between the two of them, $8 trillion. And so you have the government sector dumping, either directly sending checks to us or dumping in programs that are spending money, everything from infrastructure, which was actually agreed to by many on the other side of the aisle, to the Inflation Reduction Act, all the other junk, Bring the Chips Home Act, all these things that have been spent on. So all that has served to be, it's artificial in a sense because it's borrowed money. And let's not forget the debt clock. Do you guys, incidentally, let me just tell you, do you know how much money we are losing as a country every second? Every second. You ready for this? Every second, the country's going $79,000. It's not funny, but $79,000 further in debt every second. That's not every minute. That's every second. And the morons that work on the Capitol and that we pay money to, they're not doing anything. My God, if you're in a hole, put down the shovel, man. Stop digging. They're all digging deeper, deeper, deeper. 20 billion for this, 50 billion for Ukraine, 20 billion, on and on and on and on. Oh my God, fussing with each other about it. They're killing the country. They're not dealing with the issues. Now that is going to come into bear later this year, but that and it will. I don't see any motion in that direction that's positive, unfortunately. So you have the declining debt, you have the manufacturing index going negative, but then you say, well, our gross domestic product is very high, our labor numbers are very high. What are you worried about? Well, there's a funny thing. Government has become so big. We talked about this in a previous session we had, previous show. It's become so big that today, if you can believe me, it's 40% of the economy. Now, to give you a point of reference, it was, I think, low 20s to mid 20s when I was in college in 1968 to 71. So the government is almost double.
Okay. Let's be specific. This is all governments, not just federal government, correct?
Governments on all levels, federal, state, and local. Now, everybody that gets a check due to coercion, that doesn't go out and have to earn it in an open market is 40% of our economy. So they are having an effect. So the other thing I did, and I trusted in an economist to do it, I took his numbers, but is take the cyclical parts out of GDP and the cyclical parts out of labor and see what the rest of the folks are doing. Now, by looking at just the cyclical parts, I see declines. Okay. And what I mean by that is when you're talking labor, you take out obviously the government employees, you take out the military, you take out the educators, and you take out the medical. Medical's 50% paid by government. And when you take them out, you see a decline. Okay. When you take all those groups out. So, and when you do it to GDP and take those sectors out, the actual growth rate was in decline to about 3%. The quarter they just announced at 4.7. It was about 3 without those elements in it. So because there's a constant amount of spending by the government that isn't affected. Well, it will be eventually, but it's not immediately affected by a recession. Now, the other thing that's interesting, gross domestic income usually parallels gross domestic product. Gross domestic product is the total of goods and services. Gross domestic income is all the income all facets of labor have earned. For some reason, even though all those elements, including government, are in it, they've diverged. Gross domestic income is less than gross domestic product. It's one's going down, the other's going up. Now, that's another anomaly that you don't see normally. So, and gross domestic income is what we spend. So the other thing that I want to mention is M2. M2 is the money in circulation. The money in circulation got a big boost in 21. I've never seen it in my life when Mr. Powell, a student of Mr. Bernanke's, flooded us with money, printed money, and the amount of M2 went up in 1 year 28% in the system. Now, it's not only our system, in the world. The amount of M2 went up 28%. Subsequently, and in 22, with a year lag, surprise, surprise, we got inflation. Oh my goodness, where did that come from? Do you think the two were related? Of course they were related. The Federal Reserve created the inflation that we right now are trusting. We're trusting them to solve it, right? Good luck with that. So they created the problem, okay, with a year lag. See, there are lags involved and people don't understand them. So they assign responsibility to each other, or they blame politicians, which it's easy to blame politicians when the facts aren't exactly the same. So if that's true and it reached the lag of 12 months, we got inflation. Subsequently, in 22, guess what? M2 started going down. And now we're a year out from M2. Okay. This is one of the reasons I'm calling for a recession in the first half of 24. We're a year out. And that means there's less money in the system than there was. And just to show you how seldom that occurs, it hasn't occurred since the Great Depression. It has not occurred that M2 has gone down. But then again, you had this gigantic stimulation out of nowhere by Mr. Powell, okay, who was doing nothing other than following Ben Bernanke's instructions. Let's take the graphs down. The M2 growth. Okay, thank you, Ismail. Yeah, that shows the growth. Now, the decline is just a percentage. It's only 4% down. So I don't really like that graph. Get rid of it. The decline, so it went up 28%. It went down 4%. But the point is, it's a subtraction of money in the system. And that, in effect, is with a lag, a year lag. It happened a year ago. It started to go down. A month or two wouldn't matter. But it's been, I think, 11 months out of 12 declining, very nominally. You're going to start to feel the impact. The other thing that has been declining is the Federal Reserve balance sheet. We talked about earlier, if you remember, the Federal Reserve printed when Benedict Bernanke got there in 06, 04, and started with his outlandish theory, his just fallacious theory that created the problems we're having today. Of course, he got a Nobel Prize and a multi-million-dollar job trying to fix England now, for God's sakes. I don't know what they're smoking. In any case, Ben Bernanke started with his work in 04 when the Federal Reserve balance sheet had a little bit over 400 billion to 600 billion on it. Now, when they have billions of debt on it, it means they printed money. It means they printed money that went in the system to four to 600 billion, or they wouldn't be holding the debt they purchased to create the money. Well, they ran it up. Bernanke, of course, theorized how to do it, and he, Yellen, and Powell, of course, ran it up to almost 9 trillion. Then they went, whoops, what did we do? So they've been letting the debt come due. Now, 2 points I want to make about that. They've been letting the debt come due. The 1913 Act that created the Federal Reserve requires the Federal Reserve, when it has a loss, to assign the loss to the member banks. They're violating their own Federal Reserve and our laws every day because they're not assigning debt. They're not assigning debt to the banks. They're giving it to Treasury and we're eating it. All the people are paying their debt. The reason I'm saying that is they bought bonds up to 9 trillion at a very cheap rate. Well, what they paid for those bonds has now declined 40%. So if they paid 9 trillion, the market value, now that the interest rate has gone up, is maybe 5 trillion. So the loss is something they're transferring in addition to the 34 trillion in debt to us very quietly because it's in violation of their own damn rules. Okay, so basically the Federal Reserve, in violating its rules and going, whoops, we put too much money in the system, are taking money out of the system by letting bonds come due and people getting paid back and not printing more money, not buying the new bond that came into existence. It's a little bit hard to grasp, but that's the way they print money. They go out and buy bonds and they do a computer entry of a number, say a billion or 100 billion. It's just written as a number on a bank's balance sheet, and that created money that didn't exist, but they're holding the bonds. That's how they create money. That's their gimmick. So basically, you have a huge liability at the Federal Reserve in addition to the national debt, okay? And you also have it at Fannie and Freddie and at every bank in America, which is technically upside down, except they're allowing the bankers to do what Trump did, to claim that their bonds are a market value when they're actually 40% down, or every bank in America, including Jamie Dimon, would be upside down right now, would be insolvent. But they just brush it aside and say, well, you can count the maturity value. Forget the fact that your bond is only worth 60 cents on a dollar. My God, could we do that in accounting? Oh my God, no. Could we do that in anything in life? No. But they're doing it to us. It's being done to the American public because of the mistake they made in printing the money. So basically, not to get off subject too much, M2 has declined. I expect to start to see the effects right after the holidays. And I think they're going to be noticeable. I think things are going to quiet down and slow down quite a bit. And then the Fed fund balance sheet, they reduced it a dramatic 10.8% this week. Now, that was the biggest drop I've seen since they started a year ago. It's down to a little bit over 7.4 trillion from 8.9 trillion. Now, again, the only reason it's down is they're allowing the bonds to come due, okay? And in effect, people get their money back and the bond disappears, and then Treasury pays the people by issuing a new bond. That brings me to the last reason that I'm calling for the economy to tank in 24. Now, I want to say one thing about that. Everything's probabilistic. Now, and if I say I think the economy is going to tank, it's not 100%. It could be in 25. It could actually happen in 25, but it's going to take, unless there are dramatic differences are shown among the political class. The other factor I want to bring into play is the debt. Back to the debt. We started our show, Sunshine and Transparency, talking about it. This year, in 2024, of the almost 34 trillion in debt, over 8 trillion is coming due and is going to have to be refinanced. And they're not going to get it at 4%. It will be above 4% interest rate. And the cost now is the high twos. So they're going to be incurring another point and a half to 1.1% cost on 8 trillion on top of what they already owe. On top of that, Mr. Biden, being the spendaholic he is, has a $2 trillion plus annual deficit shortfall. The difference between what he's collected and how much tax money has come in. That has to be financed. That's going to be financed at over 4%. That is over $10 trillion in 24 that will have to be refinanced. So this notion that the Congressional Budget Office, a bunch of PhDs, lied to everybody back in May and said in 2033 we would have $1 trillion in interest. And mind you, it was 640 billion last year. It could be as soon as 2025. That's 8 years earlier. Okay, and $1 trillion to pay interest on is going to jump it above defense. It's going to make it the next biggest entitlement spending object to entitlements, and we don't have the money, nor do we have it coming in. And who's addressing it? No one. None of them. What are they doing? They're arguing about closing the border or sending money to Ukraine. One of the border is actually the cheapest option, 20 billion, but then they're talking about sending 105 million to Ukraine and Israel and God knows what else. 105 billion. I say million. So basically, the environment is very treacherous. We've never had a situation like this going forward. Now we're still the reserve currency. We still have people wanting to come into the country, but I don't want to get into why, because I can tell you right now, at least I don't want to say who, he's so well known. I've got it on information that people coming across the border are getting a $5,000 gift card and $2,000 a month. Okay, would that make you want to come here? Now, I don't want to get into that. That's off topic. So basically, we have that in front of us. We have a market trading at plus or minus 20 times earnings. Okay, we're going to talk more about that in the next 2 weeks. With a 5% interest rate, it's not sustainable. I can tell you right now, the S&P 500's at over 4,600 right now. The peak was 4,776 back on December 27, 21. We may reach that peak in a week or two. I don't know. But I can tell you right now, I wouldn't be surprised if by mid-24, we went back down to 31 to 3,200. That's an over 20% drop. Okay. And nobody is ready for that. Nobody is ready for it. So basically, we hope people start addressing the problems, the underlying problems. I mean, recessions have hit our country before, and we would survive that. But what is the terminal thing is the out of control debt that our government is every day digging the hole deeper. And so I'm going to make the fearless call. I'm the only one I know that's doing it. And I'm going to call for a recession first half of 24. It may not be publicly announced to August. It takes 2 consecutive quarters. But I'm also calling for a near-term peak in the markets. And I think it's going to start to be visible in January, the slowdown. It's not visible yet. Okay. And I hope I'm wrong. Okay. But basically, I got a call from an Eastern Shore friend of mine who does asphalt driveways and wakes up at 4 a.m. this morning, and he watches the podcast. He said, Tony, I know 3 or 4 guys. I don't want to give his name out, but I know 3 or 4 guys have told me in the last 2 weeks that the auto repo business has gone up a lot in the last few weeks. They're repossessing cars on the Eastern Shore left and right. Now, that could be another sign. Credit card debt is way above the 07 level, but so is the economy. It's much bigger. So basically, we're about the truth. If we see something one way, we're going to call it. If we're wrong, we're going to admit to it in a heartbeat. We don't want to be right about what we just said. Nobody wants to see people in hardship, but to be misled like our government is doing, and to be spending like drunken sailors on a weekend pass, and that's a kind way of saying it, without any limits, just to get public attention, is almost criminal. And neither Trump nor Biden have said anything other than ensuring everyone that they're going to continue with the entitlements. Everything has to give up something, including higher taxes, including a rework of Social Security. But unless you see these things being done right away, we're on a very perilous course, and it's not a new one. Many countries have walked this road before, and it hasn't ended up well. And nobody knows when, a year, 2 years, 5 years, but you get in a position where you turn into an Argentina, and you don't want to do that. So basically, we've taken a little bit longer outlining things. You got a bold prediction. You have a promise from us before we get back to social issues. We're going to spend 2 more weeks talking about the economy. In the 3rd week, we're going to talk about more directly some investment ideas that may mitigate your risk. I mean, it's better not to take a risk in a market that's going that's one way, keep your powder dry. But right now we'll leave it at that. We hope you all are listening. We hope we've given you some information you maybe didn't have. And to that end, we'd like to thank you for joining the podcast today. This is our 7th week. We hope to go live eventually. We're not live yet. We have to post it. And I can tell you, I wish you all to have a blessed week. And we look forward to next week's show, which will also be on the economy and finance. Ismail Madni in Austin, Texas, Tony Christ in Falls Church, Virginia, where I've been all my life. And here we are. So you guys have a blessed week. I hope you think about the things we said. And there will be an article posted on our website, odysseyinvestments.info, outlining the 11 points I made by Monday. That's odysseyinvestments.info. Go to consensus. We'll have 15 articles up when I post this one, talking about all sorts of things if you have the time. But on this particular one, the 11 points I just outlined will be in an article posted on our website, odysseyinvestments.info. Again, have a blessed week. We love you all. We hope we're shining a little bit of sunshine and transparency on America. Thank you.